welcome to Top of Mind with Consilio Wealth. I have Alex. My name is Hao. This is episode 74. Today's episode, we're really going to talk about the big, beautiful bill, and we're going to beautifully break it down. So if I add more B's, it's just going to be better. But before we do, let me timestamp and just kind of level set everything. It is July 11th, 2:37 Pacific. The S&P is off its record highs slightly at 6,259. The NASDAQ is also slightly off its record highs at 20,585. Alex, do you think we'd be saying record highs again so quickly? It was just a few weeks ago that we were like, the world was falling apart because of tariffs.
It's nuts. Yeah. I mean, 3 months ago, the market was deep in correction mode. I don't know if the NASDAQ ever hit a bear market, but the S&P was down, 15-16% at its peak?
19% down from its peak. 15% year to date was the low.
Okay,
yeah.
Okay. That's right.
Yeah, it
Not
was
quite
a bear market. It wasn't technically a bear market. It has to hit that 20, but psychologically, everyone was like in the sell mode. The NASDAQ from peak to trough was down 25%.
Okay.
And both took a full 5 weeks to recover, which is historically fast recovery.
That was quicker than COVID. That was quicker than 2020.
Yes. Quicker than, probably the most comparable one is 2018, right? We had tariffs announced around Christmas time, and by February, we recovered all the losses. Keep in mind, 2018 was just against Canada and Mexico.
That's
it wasn't like what we're doing now. So plenty of risks we're definitely cautious about. But if you look back historically, when the stock market, specifically the S&P, creates a new record, generally over the next 12 months or the next year, the stock market's up, which is super counterintuitive, right? The average long-term return or average return over the next year over like a long study of history, it's 15% up, 1.5, after a new record set, which sounds crazy, but it probably only sounds crazy because we're so in tune to down markets, right?
Right.
Always that fear of loss versus...
Yeah, we talk a lot about loss aversion.
Yeah.
But what I think is interesting is what created the panic and led to the drop in the market beginning in February, leading into early April, was the tariff talk, or really the uncertainty associated with Trump's policies. And we're kind of back in the same camp, really. So the original 90-day pause ended on July 8th, and shortly before then, Trump announced that they'd kick the can back to August 1st. He said this week that there would be no extension past August 1st. And
we've heard this before too, right?
Yeah.
We've heard,
but then we've got 50% tariffs on Brazil because Trump and the president of Brazil are going head to head about the treatment
it's
of
personal.
Yeah, it is very personal about the old president, Bolsonaro, I believe his name is. And then we announced tariffs on Canada today of 35%, which I think has to do with fentanyl. Trump's saying that a lot of fentanyl is coming through Canada, and that's seems to be personal as well, right? You need to stop the flow of fentanyl, or else you need to do this, or else. But my point is, we're kind of back to square one, but the market is not freaking out like it was a couple months ago.
Yeah, a couple things, and again, we're trying to be straight down the line with this, but how you read it or how Trump is reading it is, Alex, do you remember watching Back to the Future?
One of my favorite movies, absolutely.
Okay. When they call Marty McFly a chicken, what was his reaction?
Nobody calls me chicken.
Yes. So he's out to prove that he's tough, right? I think that's one of the reads on this, where I know that Taco meme came out about Trump, which talk was an acronym for Trump always chickens out.
Right.
That's one thing. It's like, how dare you call me a chicken? I'll show you. I'll announce more tariffs. But also the market reaction could be another signal as well. One, how fast it recovered. In his mind or his administration's mind, they're probably saying to themselves, well, the market's responding positively to what we've been doing, so we're going to keep doing more of the same. You know, that reinforcement that they saw over the last recovery, the last 5 weeks since the bottom, I think that puts in their heads that the tariff war, at least the negotiations of tariffs, which, again, everyone knows my opinion about it, is just doesn't seem like very, intelligent approach to negotiating. Right? It just seems very wishy-washy and very inconsistent. And the fact that the market really looked beyond that and is now setting new records, that could be something to watch out for too. Meaning, we've seen two new tariff announcements that Alex just mentioned. Are there going to be more? Is the market going to continue to ignore him at its own peril, right? Because if he announces a tariff, markets are up. What does that do? And I think those are the kinds of questions you should ask. We don't have the answers there. We're just saying, hey, there's potential risks here, and there could be more, given that again, despite history, when high markets beget high markets, there's still risks, right? So we proceed with caution, but again, don't sell everything that's stock related just because we hit new highs.
Absolutely.
Yeah.
It's like anything else. Diversification at the end of the day is your friend. And maybe you don't sell high at the absolute high, and maybe you don't buy at the absolute bottom, but that's the best way to mitigate risk historically. Diversification, not having all your eggs in one basket.
Yeah. All right. We just wanted to at least touch on that. But today's episode is more about the big, beautiful bill that passed in Congress last week and signed by the president on July 4th. The biggest changes in terms of dollars are going to be the permanent tax cuts. They were actually tax cuts that were introduced in 2017. So we actually won't feel much of a difference on that front, because those 2017 like marginal tax rates, right? Everyone just kind of went down a few percentage points on their marginal tax brackets. Those were actually designed or signed into law, but they were only going to be temporary, 4 to 5 years in length, right? And they were going to sunset. So that's probably the biggest dollar impact for this legislation, was to make those temporary tax cuts permanent. So everyone listening probably won't feel a huge difference. They would have felt it if those temporary tax cuts would have lapsed, but again, they were made permanent. The next big one was business tax relief, which is the qualified business income. Businesses can deduct 23%, where it was previously 20% of their qualified business income was deductible. That's actually a pretty large tax cut for small businesses. Salt deduction. The salt cap was set at $10,000 when the first round of tax cuts went into effect in 2017. That ceiling's been raised to $40,000 with a phase out of $500,000. So that phase out of $500,000 means if you earn $500,000 in income, your $40,000 cap starts going down by large chunks. If you make $600,000, you will be capped at $10,000 for the salt. And that's the state and local tax deduction. And it can't go below the $10,000. So if you make anywhere between $500,000 and $600,000, you are going to feel more of the same, essentially. And then Social Security. Taxes on Social Security are not completely eliminated, but for the most part, 90% of participants will probably be clear of taxes on Social Security.
Well, that's what the Social Security Administration said, but I think the actual data behind that is that it's much lower. I actually got an email. I know a lot of our clients did as well, saying, "Hey, the passage of this bill is great," and I think it actually referenced that 90% figure. But my understanding is that the reality is
Yeah.
most people will, I don't know if most people, but certainly more than 10% of the population will be paying taxes on their Social Security income, and not, yeah, not
Yeah.
10% or less.
I think it brings up a bigger point where new legislation, when pen hits paper, first, the IRS has not submitted any of their guidelines yet or published any
Yeah,
of their guidelines yet. And one, we're talking about taxes. Always consult your tax professional or your consultant. Um, and two, yeah, there's nearly impossible for Alex and I to give personalized information over over the airwaves here. If you have more
yeah.
specific questions, feel free to ask Alex and our team. But it is circumstantial, right? It's unique to everyone's situation.
Yeah, absolutely. I think this in particular and also the SALT deduction are great opportunities to make sure
Yes.
you're working with like a financial advisor like us or a tax planner because that's where a lot of modeling comes in handy and you don't want to make a mistake and recognize more income than you should have, which will increase the taxability of your Social Security income or will reduce your ability to take advantage of the SALT deduction. So yeah, definitely good to talk with a tax professional to understand the impact of your actions. And then just one thing I want to mention, not to go down the Social Security rabbit hole, but the data that I had referenced, or I've read rather, said that prior to this change, the estimated date for Social Security running out of the
Oh, we're running out
basically
of funds, right?
running out of funds, yeah, it was 2033, and that pushes forward the estimated date by roughly a year to 2032, because the taxability, or rather the taxes that are paid on Social Security actually goes in back into the trust
Yeah.
fund. So certainly something that we'll need to see fixed, ideally before we run out of money. We our clients will know that we continue to uh, rely on Social Security. Our clients and many others have contributed to Social Security, and we don't expect that benefit will go away. But in a worst case scenario, the ability to pay a benefit when that runs out would be reduced, and really the only source of income at that point, or the main source of income, would be
Yeah.
working individuals withholding from their paychecks.
Yeah, we'll get revisit that, but that also opens up the other potential issues with this particular tax bill. Is it's wildly underfunded, and I don't think I'm going out on a limb by saying that. It's just it's, but we've been wildly underfunded for the last
Right.
8-9 years in terms of bringing in tax revenue,
Hmm.
but also spending more than what we bring in. We'll discuss that more, but
Sure.
I think that's a more of an impact to younger Social Security savers, unfortunately, unless they
Hmm.
drastically do something uh, sooner than later. But again, it does mix politics in there because the biggest voting bloc are the baby boomers. Are they going to willingly reduce their benefits to help future generations? From the patterns we're seeing, that would be likely no. And
Hmm.
if you're a politician, even suggesting anything like that, you're probably going to get primaried or voted out.
Yep.
All right. So the next one, we'll discuss this as well. Tax on tips, no tax on tips on overtime up to $25,000 for married couples and $12,500 for single filers. And again, this is also phased out after 2028. So a lot of these tax cuts for
Hmm.
lower, I guess, lower-ish earners, most of them are temporary. So all these tax breaks that we're seeing outside of the big tax breaks are most likely going to sunset in 2028. Another one is Medicaid and SNAP cuts. We have charts to dig into that one. Basically, the Congress was trying to somehow reduce spending, but to me, they looked at probably the smaller line items They didn't cut military spending. They didn't cut interest rates spending. We'll get into that as well. Medicaid and SNAP seem to be a lot smaller line items in the federal budget. And then lastly, which we'll probably spend quite a bit of time on, is the Trump accounts, what that means for kids versus what that means for newborns over the next 3.5 years. Anything else to add before we move on? The first topic, Alex, is no tax on tips and overtime.
Yeah, I think that's interesting. So we'll notice a theme, certainly with Social Security as well, but Trump did his best to fulfill, I think, his promises or a lot of his campaign
Yeah,
promises.
sure.
So I don't recall exactly what he said pre-election. I don't recall anything being said about $25,000 specifically, but I think it was a concession, right? At least get something in there.
It was horse trading by Congress to get
Yeah,
this bill through. Yeah.
exactly. And yeah, initially it was approved by the House, went to the Senate, got some changes, right, and then went back to the House again. So yeah, this is Trump trying his best to fulfill his campaign promise, which I respect certainly. It is subject to that income phase out, as you mentioned, and it's good for 4 years. So after 4 years, if it's not renewed, it would go away.
Yeah, and for reference, it did pass the Senate, I believe 99-0. I don't know. There's 100 senators. I don't know what that last senator was doing, but the senators are all on board and keeping tip earnings or tip wages tax free. And again, we're not talking about a huge amount of economic power or economic movement or dollars here, but again, this is designed to help tipped workers. So the deduction is up to $25,000 a year for married, and it applies to anyone earning less than $150,000. I don't know if anyone working in a tipped role is making that much, unless you're maybe a bartender in like a really ritzy New York restaurant. But
are you declaring your tips?
yeah. Generally, if you're declaring your tips, that's probably the other thing we could talk about is, one, tip workers, how much of them are actually reporting tips currently?
Sure.
Because it seems, one, they might be forced to because it's always through the app.
Credit
right?
cards.
If you're
Yeah,
delivery,
your app,
through a credit card. There's no cash exchange. Or at least the cash exchange amount or rate is going down, meaning less and less people are carrying cash, and they're going to tip less cash. So yeah, making this a personal topic with Alex, he drives for Uber on the side. Just, I don't know, I figured that was more of like a social thing, just to get out of the house. But I found a really jarring report from Uber themselves, right? They reported 28% of Uber drivers actually got a tip from riders.
28? Wow.
28. I could have sworn that was like 90% because it feels so customary to tip your driver.
Well, it's interesting, and I've done Uber for a long time just because it's fun. It's a way to interact with other people. Now that we work from home, it's a nice way to have some face-to-face time with individuals. But because I've been doing it for such a long time, I've been able to see the evolution in the Uber process and the Uber experience from the driver's side. So if you go back to when Uber came out, they would say, don't tip your driver, tip is included. I don't know what that means.
I see.
But yeah, tipping is included. So you literally could not tip through the app. And then drivers came back and said, can you let passengers tip us? So that happened. I mean, it's been a while now. It's probably been like 8 years or so. But because I think initially they didn't have that ability to tip, it wasn't hardwired in most people's minds. I don't know how Lyft compares. I'm assuming it's probably pretty comparable in terms of the timeline. And then over time, I think it's slowly increased. I know we all talk about at least internally, about tip fatigue and how that
Yeah.
really
Yeah.
really began in earnest with the pandemic because we wanted to show those that were, were doing things that we didn't want to do, how much we appreciate them, the essential workers. Um, but the lingering effects have left us, certainly tired from all the tipping. But I guess that's my way of, yeah. I know
Chris and I talk
you,
about the topic a lot. We bring in Alex on like off-side conversations, and I brought up an airport self-checkout
yeah,
prompted me for a tip. I'm like, this makes no sense. I talked to no one. I just grabbed whatever I wanted, scanned it myself, and it prompted me for a tip. This is crazy. And Chris the other day sent me a screenshot where he bought a shirt online, and they prompted him for a tip.
I don't get it. And my story is I went to Pike Place Market recently and I bought an expensive coaster,
Oh yeah,
thinking, oh,
yeah.
this is a nice coaster. I mean, sure, how often do you spend $18 on a coaster? Like,
You're a tourist in your own city.
I'm a tourist in my own city, but like whatever. I want to support local artists, fine. And then, he hands me the console and there's a tip option. I'm like, I just paid you $36 for two coasters. I'm not going to give you a tip
Were they gold-plated coasters? Like $36.
for two coasters. Yeah, it was 18 each. Yeah.
Oh my gosh.
Yeah. So yeah, that makes it easier for me just to, yeah, no, I'm not going to tip. But as far as Uber goes, I would say adoption over time has kind of increased. I would say maybe from my personal experience, maybe like 1 out of 3 rides, so slightly above that figure that you read. But certainly nothing like I know you were under the impression that maybe 80-90% of passengers tip.
Yeah, that's
Yeah, I would say
what I
no.
always thought. Yeah. Okay.
But it really, I mean, you could have a long conversation about that. There are people that use Uber to get to their job, right? And if you're Ubering to and from
Yeah,
work, you don't you don't have the ability to just tip your driver even $2 or $3 each way because that adds up.
it does. It does.
So yeah, that's
All
been my
right.
experience.
Well,
And
thanks for the anecdote.
absolutely, and then yeah, certainly I'm excited about the no tipping on no taxes on tipping. That personally hits home.
Okay. And oh, actually, yeah, before we move on, do you think that raises that tip prompting? It has to, right? Because if employers are looking for ways around or looking for loopholes, wouldn't you be incentivized to try to boost your employee wages with tips, knowing that big healthy portion isn't taxed?
I think that's fair. I think the issue is that the average consumer is not going to put any thought into the fact that, oh, okay, if I tip,
Yeah,
then it
there's a
won't be
next level
taxable.
thing, right? Yeah,
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 people aren't going to think about that. And then businesses have already been putting so much pressure on the consumer to tip that
yeah.
just another incentive for them to do that is like, well, we've already been doing this anyway. This doesn't change anything because we're trying to pass on as many costs as we can to the consumer via reduced wages for our employees. So I don't think it changes things a whole heck of a lot. Uh, Maybe you'll see a store sign that says tips are not taxable to our employees or something like that. But I think that's
Yeah.
that's the extent of it.
Be more generous because they're not taxed. I doubt
Yeah,
that's going to happen,
exactly.
but yeah, that's
Yeah.
all right. The next part of that is overtime deduction. So up to 12,500 for single,
Hmm.
25,000 for joint. So no taxes on overtime has a pretty big caveat. This is probably more impactful than tips. Um, so AGI above 150,000 for single and 300,000 for joint is phased out. I think that's pretty straightforward, but I think overtime generally applies to hourly wage earners versus salary,
Hmm.
depending on what state you live in. But I think that's probably a good thing, or at least a bone thrown at hourly wage workers in addition
Sure.
to yeah
And
tips.
here in Seattle, we have a lot of folks that work for Boeing that are hourly.
Oh, okay.
And I mean, yeah, I'm sure there are salaried folks as well, but yeah, hourly, and you get that overtime. And I mean, as long as you stay below that $300,000 threshold, if you're married, then great, good for them.
All right. Moving along, the next section is auto loan interest deduction. We won't spend a ton of time here, but it's $10,000 on your loan interest for any new vehicles bought between now and 2028. again, with phase outs for individuals earning 100,000 or more, or couples earning over 200,000 or more. This is only eligible for passenger vehicles, so no ATVs, trailers, campers, things like that. And another caveat is the vehicle has to be assembled in the U.S. for that interest rate write-off to apply, or deduction, sorry. So smattering of, I thought this was going to be limited to 2 or 3 car companies, but you do have Acura, BMW, Cadillac, Chevy, Ford, etc., Honda, all down the list, includes Lucid, Rivian. So this is probably not a big deal with interest rates for cars pushing 10%. So, and again, I would question anyone rushing out to buy any of these cars, and then loading themselves up with interest payments. Like that just, again,
Sure.
the incentive there to take a high percentage loan just so you could write off a portion of that doesn't really align in my mind, other than if you're going to potentially buy a car that was produced overseas and imported in, that might be the deciding factor.
Yeah, I think it's an opportunity for a salesman to say, "Hey, this is what you benefit by
Yeah.
buying now, you know?
Yeah.
It's your lucky
Yeah,
day."
and your 10% interest rate isn't as painful because it ends up being a net 9% interest rate or whatever that is, right?
Right.
Depending on your tax rate. All right. So the next one is child tax credit. Pretty straightforward. It raised to $2,200 per child under 17, up from $2,000 per child. So not a huge increase. Qualified business income for small businesses increased from 20 to 23%. This applies to pass-through entities, and really depending on corporate structure, this could be a huge benefit to anyone who sets their business up the way in that manner, where they can deduct a pretty hefty amount. Again, that the heart of that particular cut, if you want to look at it that way, is to hopefully induce small businesses to stimulate the economy, right? State and local taxes, we talked about it, the limits and the phase outs. This will sunset in 2030, back to $10,000 cap. So regardless of your income, this is more of a 5-year break for people residing in high tax states like California and New York. And then the estate and gift tax exemption actually raised by a not insignificant amount, but it was pretty high to begin with at $13.86 million per filer. And then the new caps, or the new limits, are $15 million for single and $30 million for joint. So if you die, $30 million of your assets will pass along to your heirs without taxes, federal taxes. Washington's very different. I don't know if you want to add to that, Alex, but really, where you die really really matters.
It does, yeah. I mean, we could spend a whole episode talking about that, but at a high level, yeah, the estate tax in Washington goes up to 35%, so it's progressive. It starts at 10%, and then goes all the way up to 35, above the $3 million exclusion amount. But yeah, definitely different rules apply in Washington state, so you could be fine on the federal level, but certainly have estate tax on the state level.
All right. And then senior deduction, that's probably how the no tax on Social Security is actually being implemented, is anyone over 65 can deduct $6,000 from really any income, which is kind of a break not kind of a break, but maybe a needed break. Again, that's where that tug and pull comes into play, where seniors who are solely relying on Social Security, yes, definitely need a break. But then who pays that bill? And I think that's probably what we'll dig into more with, when we analyze the cost of all this. And then lastly, clean energy and vehicle credits all wiped out. And that's like a wipe out as soon as possible. Clean vehicle credits expire on September 30th this year. And then 529 changes. This is actually welcome. This was 529 plans were specific to tuition and books, I believe. Now that has been broadened out to different types of schooling, right? Most notably, K through 12 is suddenly no longer capped at $10,000 per year to $20,000 per year. So if your kid goes to private school, K through 12, there's actually a bigger break for 529, and the kid hasn't even gone to college yet. This also opens up to elementary and secondary schools for like religious and private schools as well. So if you had a kid that you wanted to send through private school, right, there's certain 529 restrictions where you couldn't, that the purchases wouldn't qualify through under the 529 tax shield. So I think 529 has been made better, or at least broader. I don't know if better is the right term, but that's kind of like the changes that the big beautiful bill had enacted.
Yeah, I think this is good. It's really an extension of the Secure Act 2.0, which is really designed to get people to save more for retirement, save more for education. The more stipulations and strings attached to a given policy or account, the less likely people are to take advantage of them. So I think it's great that they are making it easier to tap that money. It's certainly worthy of a conversation with your financial advisor before you take money out, because ultimately what makes 529 special is that growth, the tax-free growth of qualified distributions. So if you tap that money while your child is in elementary school, is it worth it? Perhaps, but certainly not to the same effect as it would be if you take it out when they're a junior in college. So worthy of a discussion specific to each individual's circumstances, but I think this is a good change.
Okay, and we'll talk about the Trump accounts in a second here, but the projections for the debt will increase to nearly $4 trillion over the next 10 years. Right now, we have deficit spending of about $1.8 trillion, meaning we spend nearly $2 trillion more than what we take in. And just looking at Medicaid, the line item is about 9% of that spend. The biggest line item is going to be defense at 12%, which is $859 billion. And then outside of Medicare, moving up to 16% at $1.1 trillion, and Social Security at $1.5 trillion, which were not cut. And net interest payments at $952 billion. That's just interest on our debt. We're paying nearly $1 trillion on. Obviously, that isn't cut. So I think that's one of the things that will get exacerbated, right? I think one of the ironic things is everyone was worried about the debt until they weren't. That's kind of one of my predictions heading into this year, where we were going to increase debt. It's just been a pattern that we've seen from Washington, regardless of the party in power, is we spend more than what we take in, which is something that we haven't solved for 50 plus years at this point. And the cost of Social Security, as Alex pointed out, those taxes go back to buffering Social Security up. So if you're retired and you're taking Social Security, you are taxed. Again, I forget this specific amounts, but those tax revenues go back to help refund the Social Security pool, which, at last glance, the program was expected to run out of money by 2035, which is only 10 years away from now. And with this new tax bill, they lost a couple years, right? Is that a good trade-off? I'm not asking if that is or not, but you see where the tug of pull comes in again, right? That's just a lot of hard decisions, right? Do we take money from retired people who are probably unable to get back into the workforce, probably shouldn't get back into the workforce? They're already retired, right? Like that's kind of a tough ask. At the same time, by benefiting them, you shift the burden onto younger generations, like Gen X, the millennials, and then Gen Z. I think some kind of bill has to be paid here, unless we figure out how to kick the can down the road without really looking at the debt, which is kind of wild to say.
Yeah, I think it's interesting, and the challenge with being a politician is the same sort of challenge that comes with being a publicly traded company. It's all about short-term results, which can be to the detriment of long-term gains, or in this case, future generations. Uh, and as it pertains to Social Security, it sort of means you deal with it when you have to, just like you have to deal with the deficit when you have to. I think it's interesting. I know we talk a lot about the 10-year rate because it impacts mortgages.
Yep.
The rate is down, I think, about 40 basis points or 0.4% from its peak a few months ago, which is interesting. That's not insignificant, but certainly well above its low, its yearly low, which is what, around 3.75, if I'm not mistaken.
Yeah.
But as far as Social Security goes, I think they're probably just going to deal with it when they get there. It would be unpopular to make any changes before they did, and it'll likely be a combination of pushing back full retirement age. You may recall that there was a gradual adjustment or increase in the full retirement age from, I
Yeah.
believe, 66 to 67. So if you were born in the 50s, then you saw your full retirement age slowly go back, depending on the year you were born. So now the full retirement age is 67. I would expect that will get pushed back, not unlike the required minimum distribution ages, which eventually, depending on when you were born, it's 75, and it used to be 70 and a half. So
I
unrelated.
can see that moving up
Yeah,
earlier in age, right? Like, hey, you got to take money out of your IRA at
that's
68 years
fair.
old,
That's
right?
fair. That's what,
Versus delaying the revenue, because
yeah,
that all it is like a revenue question: is how much are we taking in,
yeah,
or how much are we willing to take in? Because it's pretty apparent that there's an unwillingness to cut meaningfully, right?
yeah,
Because I think by line item, we're choosing one of the more marginal line items in Medicaid to cut, and even then, it's
hmm,
like a fraction, right? If you cut all of Medicaid,
right,
you're still in the deficit of 1.2 trillion, and that's if I kicked everyone off Medicaid. Like
right,
that's not really answering some of the harder questions. It's
hmm,
just it's just picking on the people who probably aren't your voting bloc, which is that's the way
right,
politics is. But
yeah,
again, yeah. All right. So one more thing before we get to the Trump accounts: 1% tax on remittances. This might impact a lot of our client base. If you send money overseas to family, right? Let's say you make $100, you tax on the $100, and then you send, $8 over to whatever country that you're sending to back home. That's a 1% additional tax now. And then that is down from a 3.5% proposed tax. So if you're sending money overseas, that's a 1% tax. All right. So Trump accounts. This one, a little quirky, meaning any child born between 2025 and 2028 will automatically receive a $1,000 government seeded account for when they reach the age of 18. And then when they reach the age of 18, they could withdraw that money for, they said qualified purchases. But again, this is something that you should always check with your tax planner. Qualified purchases being education, a home, and I believe I
I think it's
saw
specifically a first time home purchase.
first time home purchase. So there could be quite a bit of benefit for kids to kids even now, because anyone under the age of 18 obviously wasn't born over the next 3 years. Their accounts can still be funded with $5,000 a year up until that age, so they can use those funds, which has like a small menu of investments, either mutual funds or ETFs that are low cost, which is actually something we agree with. When they reach 18 to spend on anything that qualifies. Did that make sense?
Yep,
So
yeah, and then
two setups, yeah.
just to expand, so they can also use it on a small business loan or expense. Uh,
To start a
so
business, that's what I was missing. Sorry.
yeah, no problem.
Yeah.
And then so yeah, it's funded with $1,000 of seed money if you were born 2005 to 2008. Like, great, $1,000. Uh, it sounds like it has to be invested in the U.S., like a broad-based U.S.
Oh,
mutual.
yeah.
So invest in the U.S. I guess probably the logic there, and then uh, yeah, you can take out up to half when you reach 18, and then when you turn 25, the rest becomes available. And happy to get more granular on this, how, but at a high level, if you're using it for one of those qualified uh, distribution purposes, then it's treated as a long-term capital gain. And if you're not, then it's treated as earned income, which is at the whatever your marginal tax rate is, and then there's
Yeah.
also a 10% penalty on that based on the information I have.
Yeah. So this will be our last topic, but what you see this being a replacement for anything, 529 specifically, or more of a supplement? Like putting money in different buckets that have different benefits for different uses.
I think the challenge with this account, and to a lesser extent 529s, is that when your child is a baby, like you have no idea what their life is going to look like. You have to make kind of an educated guess as to what direction it will go. We could have a whole conversation about whether or not college makes sense now, and certainly a more esoteric conversation about whether or not it'll make sense for when your kids are in college, right?
Yeah.
Uh, that being said, 529s are a bit of a unicorn, really, because assuming you meet that
Yeah.
checkbox, you use it for qualified education expenses, tax free. We love Roth IRAs, we love Roth 401ks, and
HSAs. Yeah.
HSAs are even more unique. Yeah, exactly. But tax free growth, it just feels great, right? So that's why, to expand on what I mentioned earlier, it's so nice to start that earlier. Um, the the shortcoming that I see in the Trump account is that there's no immediate tax benefit. Sure, you get $1,000. That's great. Uh, but contributions are not tax deductible, like they would be in an HSA account, like they could be depending on your state of residence in a 529. So if you live in Virginia, for
Yeah.
example, there's a state tax deduction, even if there's no federal benefit. Uh, and you're still getting taxed down the road in some capacity, whether it's as at the long-term capital gains rate or earned income, it's still getting taxed. So I think that's the issue or shortcoming with this. Uh, I think realistically, the people that will actually use them are the top 10%. They're already maxing out, putting as much money in the 529s as they can.
Yep.
They probably are already putting money into custodial accounts, maybe very growthy assets which don't pay dividends, so they don't have to worry about the kiddie tax. And this is just another, lever that they can pull to create tax deferred growth. So they'll still be paying taxes on it down the road. It's all deferred. So I think it has its benefits, but I think for most people it's as simple as like, hey, you gave me $1,000, you gave my kid $1,000, great. When they're 18, they'll tap what they can and they'll tap the rest when they turn 25. I think that's what we're likely going to see for 95% of people.
Yeah, yeah, and even the kind of the big loophole with 529s is $35,000 max of unused 529 balance can convert to a Roth over time. I think that's a huge benefit to tax-free growth if you overfunded a 529, which is like another benefit for that type of account, which
Mm-hmm.
should see a priority in that order, even if the kid goes to college or not, right? Because the benefit the downside of that is they don't go to college. Yeah, you can reassign the beneficiary, or
Mm-hmm.
worst case, you take the 10% penalty on the growth. You get your
Right.
principal back tax free, but that growth is considered, well, ordinary income at that point if it's not used for college, and then the 10% penalty. But still, that's you're saving. I think that's really the heart of all this is one, we as a country don't have a very high birth rate. Right now, the average birth is 1.6 children for every two people, and at replacement level, you need 2.1 kids, and we're not accomplishing that with the native born population,
Mm-hmm.
and that's probably why you're getting that $1,000 for every newborn from now until the next 3 years.
Interesting.
And it makes sense, right? Because the economies grow as the populations grow. The population shrinks, right? You can name whatever country or region around the world, because there's a lot of it happening, where population shrinkage is probably the biggest issue with economies. And if we're trying to solve that, does it seem more? Does $1,000 move the needle? Probably not, right? That's like a half a month of daycare here in California for a single kid. So that's why if we're really trying to be meaningful about it, the child tax credit probably does need to be more meaty. But then again, you raise money there, it has to be taken from somewhere else, if that makes sense, whether raising taxes or cutting some other social program. And this seems to be more of the same, despite headlines. And I just don't mean to sound cruel. It's just not a lot has changed in terms of deficit spending or meaningful cuts or anything that was promised if you were voting for Trump under the guise of reducing the debt.
Yeah, I candidly was very surprised with not only it getting passed in the House, but getting adjusted and then passed in the Senate. I mean, it was a 50-50 ratio, and then Vance had to break the tie. But
Yep.
I was surprised that with so many individuals that say they're fiscally conservative signing off on this, I don't know if to what extent the threats became an issue, because Trump was certainly making, I don't even know if veiled threat is the way to say it. He was making overt threats, because he had July 4th as his date where he wanted to sign off on this. Uh, but yeah, I'm surprised. I think a day of reckoning is coming. I thought it might have been on the horizon in April, but things have settled down. Interest rates have dropped, as we talked about, since April. But at some point, we need to, well, we have to continue financing our deficit. And I think it's pretty safe to say that tariffs will not cover the majority of that
No,
shortfall.
no. It covers
So
about 1% of the federal budget.
yeah, so there's a day of reckoning coming where either we have to reduce our spending, or we'll just have to pay some exorbitant amount in interest that is just not feasible.
Yep. So I know we went through a lot. I can't stress enough how important it is to sit down and plan your tax strategy before April 14th, April 15th. By that time, it's way too late to do anything. Even in December, you got to look at it from a year long strategy. And if that sounds daunting, that's why professionals like tax planners exist, right? Like this is what I guess the well-off do is tax planning happens every single day of the year, right? Not just December 31st and definitely not on tax day. So what we put out is not tax advice though. And everyone's situation is really, really different. And when the IRS publishes its standards, that can very well change too, because interpretation has a lot to do with this, right? Because we just read and summarized the actual bill. That was like 330 pages. And once it translates to the IRS, there could be changes. The phase outs might not, but like the interpretation of certain things, like what's qualified purchase, what's a qualified savings can change. You have to, at least in this scenario, focus on what you can change or control or take advantage of in the new tax code. But it starts January 1st of this year, which I know, major tax legislation introduced mid-year is sometimes unfair, but I think that's kind of like the spirit of why we're bringing all this up, is because you have to do all that stuff yesterday.
Yeah, I agree. At a high level, I might say just talk to your financial advisor or your tax planner and say, hey, I know some things change with the one big beautiful bill passing. How does that impact me? What changes should I be considering? It certainly affects our clients, particularly retirees, but even those that are still working, just have that discussion with your financial professional, and they can give you more specific advice, whereas it's more broad-based.
Yeah, and if you need guidance, we can help you still. Even though we're not tax professionals, we can still help steer you in the right direction.
Absolutely.
Okay, anything else, Alex, before we end?
Oh, I mean, I could go down a rabbit hole, certainly, but I think that's enough for one day.
Yeah, 52 minutes. So, thanks for everyone for hanging with us. I think this was an important episode.
I agree,
Yeah.
and I'd like to think that we're elevating our game. So when Chris comes back, he will be impressed, and our viewership will only continue to rise.
All right. Well, thanks again, Alex. We'll talk in a few weeks because, it looks like you'll be filling in for a few more episodes.
Sounds good.
Yeah, this has been fun.